Start with you and ask you just about the way that investors are processing what's happening with the Fed here in the U.S. You mentioned the jobs report that we got last week. Of course, now there's speculation about when the Fed is going to unwind the balance sheet, if that's going to be in September or later. How are investors preparing themselves for when that, in fact, occurs, and what do you think the ramifications of it are going to be?
Well, right now, what I'm surprised by is the risk, or rather the lack of risk being priced into markets, that things are much better in the US than what the jobs number or the inflation numbers are suggesting right now. So it seems like investors are just positioned for steady as she goes, not much going to change, Fed not rocking the boat. But what is the threshold for when US data actually starts to surprise on the upside, especially when wage growth translates into consumption growth? Are we braced for that? I don't think we are at this point.
Holger, let me ask you just about, Geoffrey, they're saying steady as she goes when it comes to the markets. Let me ask with regard to inflation and jobs in particular. We had another downward move here when it comes to the unemployment rate here in the U.S. Do you foresee that continuing? Do you see anything that could change the course of that downward trajectory?
Probably not. We will have more people coming back onto the labor market in the US, but the unemployment rate looks still likely to decline very modestly over time. The real story in the US remains that the economy is not overheating yet. So steady gains in the labor market, a steady outlook for consumption growth at around 2% probably translates into only a very modest updrift in inflation. Hence, the Fed can take its time. They will take their time, and they will, as much as they can, try to not rock markets too much.